Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Blikre, your host, and with me is Yahoo Finance's Brooke DiPalma, who's here to connect the dots and to be your personal bridge between Wall Street and Main Street. And today we're going to be looking into the recent bullish price action in technicals in stocks and crypto, along with some options talk and a look into earnings season right around the corner. And our word of the day is volatility. It's more than just the so-called VIX. We break down what you need to know. And on today's Market Show and Tell, we're talking simple options trades in Google's Alphabet. It's up 70% since those April lows, and we're going to tell you how to squeeze a little bit more juice out of this Mag 7 leader. And this episode is brought to you by the number 8%. As we head into earnings season, that's how much profits are expected to grow in the S&P 500. We will tell you why those estimates have been rising and why the uptrend is so unusual. And today we are welcoming back Bob Lang, who's the founder of ExplosiveOptions.net and a veteran options technician who specializes in our word of the day, volatility, risk management, as well as trader education. He has mentored thousands of retail and pro traders, and he also wrote the book, Know Your Options, How to Build Wealth Using Proven Options Trading Strategies and Technical Analysis. He's also a frequent guest on the Yahoo Finance Network. Welcome back, Bob.
Great to be here, and really enjoy your show. The program is fantastic. I watch it every chance I get and tell everyone all about it.
I appreciate that. And why don't you just begin with telling us how you're seeing the market right now?
Well, hitting new all-time highs, there's nothing bearish about that, of course. But it does seem a little bit scary. At some point in time, the market's going to come down, and it's going to surprise a lot of people. What we've been experiencing for the past few months, Jared, and has been the dip buyers. Dip buyers have been very active, pulling back when the market comes down to like 8-10% correction, pullbacks or whatever. The dip buyers have been right there and buying the market up. So, I mean, why fight the trend? Why fight the momentum when that's been the order of the day? That's been the pattern that I've been noticing for the past several months.
Yeah.
And time now for our word of the day, which is volatility. And it isn't necessarily good or bad. It's how much and how fast prices move. Now, higher volatility means wider swings, and more uncertainty, while lower volatility means steadier prices. Now, when it picks up market-wide, even sturdy stocks, they can feel a little jumpy there. But with higher volatility also comes opportunity. And so, Bob, how do you think about this concept and how do you navigate it maybe as a first-time investor? When do you jump in?
Well, Brooke, what people talk about volatility as being a trader's best friend. And frankly, that's true, and it's not true. It's true because volatility opens up opportunities for the market when the market comes down to buy options or stocks or whatever. But if I'm an options trader and I'm looking for options to move in a particular direction, what am I looking for? I'm looking for momentum. And momentum is created by lower volatility. I want to see lower volatility sustain itself for a period of time. And what does lower volatility get to? It gets you that investors and traders are much more comfortable adding money into the market and staying in the market for a period of time. So money keeps flowing into the markets. We see prices going up and up and up. Remember something: the market is a discounting mechanism for the future. It's also an area where the supply is short and the demand is strong, then we see prices just continually going higher. And trying to step in front of that train, good luck.
Yeah. One of the things I track seasonality, and I measure seasonality and volatility. And one of the trends that we kind of observe is that volatility starts to trend slowly up in August, September, and then it tends to peak in October. So that means you would have a higher VIX, which, by the way, is just measuring options on the S&P 500. So we're just talking about a generic stock index here. But October is a time when we've seen historical market crashes. And sure enough, I've noticed volatility creeping a little bit higher. Is this concerning at all? How do you use VIX or how do you use the VIX or volatility in some some of your work and just trying to time the market?
Well, first of all, I'm going to take you to the side of that position with the crashes. Also, October is notoriously called the crash month, but it's also a month where we've seen market bottoms settle in too. So we've seen market bottoms in 1929. We saw it did go down a little bit later on the net. We also saw a market bottom in 1987 when the market crashed back then. So the market did bottom in those two instances, and also in 2009. So I would look at the volatility as an opportunity to get in. But you have to understand the movements in volatility, the seasonal patterns that are going in place. Look, we just started October, which is a seasonally strong period to the end of the year. And when you look at the history of the markets this year and in past years, when the first 9 months are up strong, like they are this year in 2025, the odds are favoring the markets going up into the end of the year, the last 3 months of the year. So that's a trend I really don't want to fight.
Yeah, and it's certainly insane to see this momentum that we have ever since those April lows.
Yeah.
And we're even getting some year-end calls that the S&P 500 could go even higher, reaching as far as 7,000.
Right.
We heard from Evercore, Goldman Sachs, Wells Fargo.
Yeah.
What do you make of those year-end calls? And will the momentum just keep on moving on?
Well, frankly, trying to pin the tail on the donkey when you're blindfolded, sometimes it works, but usually it doesn't. So
Is that where we're at now?
That's kind of where we're at right now. I don't really pay attention to what some of the analysts are saying, the strategists are saying, because they know the market is overbought right now. But remember something, overbought is simply just a condition. It's not a signal. So markets can be overbought for a long period of time. If you look at some stocks, look at Palantir.
Good point.
For a while there, and even Google, what name we're going to talk about later, for a whole month and a half, this stock was overbought. And you could have picked at any point and said, okay, that's enough, I got to get off, and you were wrong. It just kept going and going and going. So eventually the stock market is going to signal to you to say, hey, look, you know what? It's time to go down. An overbought condition doesn't necessarily give you that signal. It's just simply a condition.
All right, let's jump into our new segment, Market Show and Tell. And we're going to lean on your options expertise here, Bob. The ticker is Alphabet, which is one of the top Mag 7 performers recently. And there's been lots of bullish AI headlines as antitrust risk has faded. But we want to talk about some of the technicals and specifics here. You're looking at you're looking to buy a call option in Google's parent company, Alphabet. And a call option gives the buyer the right to buy a stock at a set price by a specific date. So what are some of these specifics that you're looking for in Alphabet? Kind of map out the risk and reward.
So I'm looking for Alphabet. Okay, so if I'm looking at about a 6-month play, and we're talking about March or April, I have to kind of handicap myself by saying that what is my expectation for what Alphabet Google is going to do next year, right? What's a reasonable amount of return that we can get in a good market? What does the market setup look like? We got a friendly Fed. We've got a friendly business environment. We've got deregulation coming in. We just recently heard that Google settled with the country of England. I think they have another settlement coming up with Europe and so forth.
Lots of levers here that are currently in Google's favor.
That's right, Brooke. And so these things are definitely bullish for Google. So if I'm looking at Google, I say, it's a mega cap. I want to, pick something ridiculous in terms of a target for next year. No, I'm thinking maybe the stock could do 25, 30% next year, right? If all of these things work in their favor and stay bullish. Of course, anything can change. So if I'm looking at that, maybe for the next 6 months, could the stock do 10, 15%? Sure, why not, right? I mean, if the conditions remain favorable, you got a couple of earnings reports into March. We've got the October report coming up in a few weeks. We've got January report coming up, and then into the early part of next year. So if the stock remains bullish, I mean, I'm looking at maybe going about 3 or 4 strikes out from where the current price is right now. I think it's about 242, 244. Maybe go out to the 260. And if the stock makes a 15, 20% jump, that option is going to be very profitable.
And let me just follow up here for the audience, maybe somebody who's just getting their feet wet in options right now. You're talking about buying a call. So you are paying the seller of that option what's called a premium, and you don't get that back. So if this trade doesn't work out in your favor, if the stock price doesn't rise to that strike level by your target date, by expiration, then you lose the money. any other risks that investors should think about as they conduct some of these options trades?
Well, as far as buying calls are concerned, look, it's a cash settlement. It's cash only. There's no margin involved. So whatever I'm buying in terms of a call option, that's the most I can lose.
Defined risk.
Defined risk, right? I can't lose anything more than what I put into it. So if I'm paying for an option that costs, say, $15 for one contract, times it controls 100 shares of stock. So it's 100 times 15. That's going to cost, one contract's going to cost me $1,500, right? And you think, well, okay, that's the most I can lose. But the most I can make, is technically infinity, right? I mean, the stock could keep going up and up.
Google could hit infinity someday.
Yeah,
All right,
well,
now we're
wouldn't that
getting
be?
bullish, guys.
Wouldn't that? Wouldn't
trying
that
to
be nice,
mislead
right?
anyone.
So if it's all about managing risk, right? And I know $15 for an option is somewhat expensive, and for somebody who is just starting out to plunk down $1,500 on a trade is
Because you're buying
not easy to do.
basically 100 shares.
Basically 100 shares, right? But if the stock is trading at $243, buying 100 shares of that, it's going to
That's
cost
a lot
you
more money.
Right.
That's
$24,000.
the nature of
right?
leverage.
But I'd rather, if I'm going to lose money on a trade on Google, I'd rather lose $1,500 than $24,000. Although it's not going to go to zero. But the theory is that my risk is contained, is, as you said, defined risk with the option trade, and I can't lose anything more than I put into it.
Bob, we have so much more to get to, but we do need to take a quick short break. But coming up, we're talking about an unusual jump in expectations for earnings season, and we're stepping onto the court for a tennis-themed Run Day Showdown. Stay tuned. This episode is brought to you by the number 8%. That's how much Wall Street is expecting earnings per share to jump in the S&P 500 this earnings season. Now, what's notable is the direction of these estimates. Analysts typically lower their profit forecasts ahead of quarterly reports, which then lowers the bar for these companies to clear. Bob, when you think about these expectations, what are these higher expectations? Yet again, another earnings season that we're seeing higher expectations going in. What is this telling you?
Well, as you said, it's raising the bar for performance, right? And
quite high.
Quite high. And I think I want to say about 2 months ago, the estimate was for about a gain of about 3 to 4%. And there were several sectors that were showing negative, like home builders and even retailers and some discretionary.
So losses being baked in.
That's right. So I think that sets up a little bit of disappointment. But look, somebody told me a long time ago, it throws me this question: do you really want to be short during earnings season? And you want to be negative, you want to be short, and really the answer is no, because a lot of these earnings that companies deliver, usually they outperform, and the market tends to give them a little bit of a break. There's some companies that, look, technically they don't look very good, and if they disappoint, they're going to get punished. But companies that are doing better, I look at a company like Robinhood, which has been an unbelievable performer in
Year-to-date
2025.
growth has been tremendous.
Up over 300% since those April 8th lows.
So you might want to think, okay, well, maybe, and just for the past few couple of months, when they got inserted into the S&P 500, the stock is up enormous, and you might think to yourself, well, maybe the good earnings are already baked in. I'd say not so fast. I'd say, look, you got to pay attention to what they say and what they're doing, and going forward, they have some great relationships, and certainly with AI and with crypto, they're doing a lot of good things, and maybe they only beat by a little bit on their earnings, but it's going forward, they might be well and do well, and technically the stock is really in great shape.
Bob, I'm wondering, what do you do during earnings season? Are you listening for certain things on the call? Are you looking for guidance? Are you looking to day trade with options? Some of the results, what do you do during earnings season?
Well, during earnings season, I'm looking for the highest quality names and the highest, best looking charts that I can find. I'm looking for options flow. I'm looking for interest from big institutions that are coming in and buying these names. Because, look, big institutions, they don't just step in there in one day and just buy everything. It's very methodical and very slow, and they don't want to make a big splash and show everybody, hey, look, we're here. It's like an elephant.
Unusual options activity banner on the TV. Yeah.
Well, that's exactly right. But you know what I mean. I want to be a fly on an elephant's rear end when he's stepping in the room and buying stocks, because if he steps in water, everybody's going to get wet, and everybody's going to know about it. So I really tend to take this earnings season very seriously about finding the best trends, the best momentum stocks, and going with those.
You know, what's interesting is there has been that discussion recently that there could only be 2 reports every year as opposed to the quarterly reports that we have now. You know, when you think about what that could mean for investors' knowledge about a company, if you're just getting started, where else do you sort of get in to get hindsight or insight into the company?
Well, you just talked about volatility a few moments ago, right?
Right.
Well, 2 fewer reports a year is going to reduce the volatility of the market, right?
Is that a good thing?
Well, for a trader, probably not. But I mean, for an investor, it's probably just fine. Look, I mean, it was about 6 or 7 years ago that a lot of retailers stopped giving monthly guidance, except for one. Costco is the only one that still gives monthly guidance. So, there was a lot of volatility around some of those numbers that came out with monthly guidance and so forth. They stopped doing it, and volatility started to come down with some of those names. So I don't think it's that big of a problem or that big of an issue. I mean, earnings are earnings. They're still going to, you still have to deal with them. If it's 2 times a year, or if it's 4 times a year, you're still going to have volatility around those events because of the uncertainty, and people want to get prepared for those.
You mentioned charts a minute ago, and I know you use some technical analysis. Tell me about some of the tools that you like. What's in your toolkit?
In my toolkit, I love to see momentum indicators.
So like RSI or?
Like the RSI, like the MACD. I also look at money flow indicators, like the accumulation distribution. Chaikin money flow is one of my favorites. I also pay attention to what's happening on the price chart because, look, number 1 indicator is the price chart. Number 2 is volume. So if I'm looking at a chart and I only had the price action and the volume and I didn't have any other indicator, I can get a good read.
I agree totally. I love that.
I can really get a good read for where the market's going to go or where a particular stock is going to go. But I have all these other supporting indicators which help me really get a bit clearer picture of where things are at. So I'm looking.
By the way, we have all those on the Yahoo Finance app and site for free.
I use them all every single day.
Excellent.
Fantastic. But as far as the price is concerned, moving averages are so important because moving averages act like a magnet. Right? They pull the stock back to the.
It's like self-fulfilling almost.
That's correct. And when stocks get too far away from the moving average, it pulls it back. When it gets too far down away from the moving average, it pulls it right back up again. So you can kind of really define the space where you can start getting in and getting out of stocks.
Moving into the end of the year, we talked about those S&P 500 targets. We talked about the momentum that we're seeing behind AI. We also are seeing momentum behind alternate assets as well. How do you make, or what do you make of this year-end momentum that we're getting, especially into those alternate assets? And how do you sort of understand where to go right now?
I think you're talking about gold, right?
Maybe.
Which just
Bitcoin?
Bitcoin.
Yeah, let's talk crypto and gold.
So crypto and gold. So I think that there's a lot of enthusiasm and a lot of excitement with alternative assets. I think we've seen some weakness in the dollar and so quite a bit of distrust.
Down about 9% year to date.
Sure is. Yeah, so a lot of distrust around the world with U.S. dollars. And, as the debt continues to grow and the obligations continue to grow for the United States, I think there's a lot of countries out there that are worried, are we going to pay our bills? And, we have a president here who's got different policies than other presidents in the past, and who knows? He seems to be very creative in putting different ideas together. Investing in companies like Intel and other, that's kind of unprecedented right now. But things are different. So I think the uncertainty there creates this demand for alternative currencies aside from the dollar. So that's where you're seeing a lot of interest in crypto and in Bitcoin and gold and silver, platinum. All these names are starting to move up. But I do think that the excitement and enthusiasm about Bitcoin is going to push that through probably through 150,000 by early next year.
150,000?
It's only 123 right now.
Yeah.
All right, that is a target. That is
I'm writing that down.
All right, now we have got a market's take on a classic Hollywood gab show staple. Who wore it better? Today, we're channeling the tennis world. On the left catwalk, confidently struts the big serve. It's power first, make a statement, then win the point before your opponent even blinks. In market terms, that's a decisive move. Strike while the window's open, take the lead, don't overthink it. And on the right catwalk, we've got the perfect return. This is composed, calm, see the ball, send it back with purpose. In markets, that's patience under pressure, absorb the hit, read the bounce, turn defense into opportunity. So Bob, which style owns the runway today? Is it the big serve that blasts through or the perfect return that flips the script?
Boy, you're talking my language here, Jared. I play tennis 4 or 5 times a week, so I'm right there.
Excellent.
I love to play tennis. I'm mostly doubles and play with my wife, mixed doubles, and I play with.
You must
So
be good.
I love it, and it's been so much fun. But I'm going to go with the big serve.
Okay.
That's
Out
where
of the
I'm
gate.
at. I love the big serve, and a big serve can really take your opponent out of the game. And fortunately, I've got a good serve, and that works in my favor. So,
All right, talking your own book. I always appreciate that.
I wish I had a little bit more of my game to complement with the backhand and a forehand, but that's where I'm at.
Now, Bob, for the everyday investor just looking to get in, would you also recommend the big serve?
No, probably not. So, I've been in this business for a long time, and I've taken chances, taken risks where I can, and taken some hits, but also get a little bit of reward. As another analogy in baseball, you got to take some risk, right? You can't steal second with your foot on first, right?
You're right.
So if you got to step out there and on a risk curve a little bit, but there's smart ways to do it, and again, with options, there's smart ways to do it as well.
Under a minute. I love to talk about risk management. I know that's one of your themes as well. Any final words for the viewers?
Managing our risks, this is one thing that we all can control, and we can always control what we have in our portfolios at risk. So if you allow yourself to let the market take control, then you're going to eventually get punished by sellers, or when the market's ready to turn the other direction. So I think that the most important thing is to learn your risk management rules, and pay attention to those, and be true to those rules, and you're going to be fine and live to fight another day.
I would underscore that 1,000 times, and always have a plan, ideally in writing. Well, I mean, we've learned a lot here today. We started out with volatility. It's used a lot, but it can also lead to opportunities. And Bob, you reminded me that even though we tend to get market crashes in October, at least historically, that also means there are opportunities in October. So that's the flip side of that coin. We talked about technical analysis, the importance of being able to read a chart. Even if you don't have any indicators, doing it blind can be an important skill for everybody. And then just thinking about some of the options trades, we kind of broke down a call trade, but that's another case where you have defined risk up front. You lose potentially what you put in, but you have an infinite potential payout, and you don't have infinite potential loss. And I think that's kind of a big thing for people just stepping into the options world. So it's official. We are winding things down here at Stocks in Translation, but be sure to check out all our other episodes of our video podcast on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms, so be sure to leave a comment, and subscribe wherever you get your podcast. We'll see you next time on Stocks in Translation.